morning and welcome to the first session of the 2022 Foundation Forum. In this session, we talk about economic and social convergence and resilience in Europe, the impact of COVID, and the future challenges that we have in front of us. It is not easy to discuss the challenges of crisis in a moment where the dramatic events following the Russian invasion to Ukraine are unfolding. Events whose consequences will affect deeply the region and Europe for the years to come. And this new crisis actually come on the top of the COVID-19 crisis. 2 years ago, almost to date, the COVID-19 exploded in Europe, becoming a global pandemic. As a matter of few weeks, what started as an health crisis quickly became an economic and a social crisis. And as a modern Kerberos, the three-headed hound, guardian of the Hades of the Greek mythology, these three crises affected deeply the life of our citizens and put a tangible risk over economic and social convergence of member states and regions. The European Union and its member states quickly reacted to this crisis with audacity and imagination, smoothing the first impact of the COVID-19 crisis, paving the economic recovery that now we see. But how did it go? And what will be the future challenges that we have in front and how they will shape our future? We will discuss the present and the future with 4 prestigious speakers. Barbara Kauffmann, who is here with me in studio. Barbara is Director of Employment and Social Governance at the European Commission and is member of our Managing Board. Good morning, Barbara. Morning. Debora Revoltella, Chief Economist and Director of the Economic Department at the European Investment Bank. Good morning, Debora.
Good morning.
Zsolt Darvas, Senior Fellow at the Brussels-based think tank Bruegel. Good morning, Zsolt.
Good morning.
And finally, last but not least, Natacha Valla, who is Dean of the Sciences Po School of Management and Innovation. Good morning.
Good morning.
But first of all, before giving the floor to the speakers, 20 months after the COVID-19, let's set the scene on the economic implication of the COVID-19 and how did it go with a short video.
In 2020, what started as a dramatic health crisis became the most profound economic and social crisis since World War II, much bigger than the 2008 recession. We can see how the COVID-19 plunged the EU into recession. Although this crisis was only due to external factors, a virus and the subsequent political health restriction, the impact varied greatly among member states, depending on their economic structure. The fall in GDP levels created economic divergence between countries, putting an end to a period of positive upward convergence. Convergence is one of the EU key political aims. It translates into Europe's commitment to lasting economic, social, and territorial cohesion. Convergence is important because it's how we measure cohesion. Upward convergence means monitoring when member states improve their performances and move towards a certain economic and social policy target while decreasing disparities among them. It is a technical word, but convergence is at the very core and the foundation of the EU project. Without it, we risk economic, social, and political instability. The shock to job loss was huge. In early 2020, there were 5 million less people working in the EU than in 2019. Lockdowns and social distancing measures to prevent the spread of the virus led to unemployment in hospitality, entertainment, and travel sectors. But not all industries were negatively affected. We saw increases in staffing in telecoms, computer programming, and pharma manufacturing industries. These may have reflected the shift to home office work and an uptick in demand for pharmaceutical products during the health crisis. Also, we saw that some countries fared better than others. And those hardest hit were the ones most severely affected by the COVID-19 and also relied heavily on tourism, services and global trade. The EU employment rate fell from 73.1 to 72.4%, with Spain, Ireland, Bulgaria, Lithuania and Estonia seeing the biggest drop. But as the pandemic continued, the comparison with the 2008 crisis revealed that the impact on unemployment was in fact much less severe. In 2020, unemployment only increased from 6.7 to 7.1%. Latest GDP growth shows a V-recession for many countries with a quick and sustained recovery. In 2020, there was a significant national and EU-level policy response. A raft of support measures were introduced and the EU Recovery and Resilience Facility was set up. This temporary recovery fund, made up of a massive 723.8 billion in loans and grants, allows the Commission to raise funds to help member states and address the challenges identified in country-specific recommendations under the European semester. So what would have been the dynamic in unemployment in 2020 if governments had not reacted and the EU had not responded? Let's assume the relationship between GDP and unemployment is the same as over the last 20 years. And then let's imagine that member states and the EU did not intervene or provide any support. What would have happened? Our calculations show that without policy intervention, unemployment would have been around 11.5%, 4.7 percentage points higher than it is currently. So what does the future hold? The latest data points to a strong economic performance after a sharp economic decline. The questions now are, will this growth last? What will happen when the support at national and EU level is discontinued? Can we live with high debt and high inflation, and how? How can we ensure that we maintain upward convergence in the economic and social dimension? And do we have all the necessary tools to do so? Stay tuned and listen to our experts.
Welcome back. So we have big questions, and now let's hear from our experts. And for those who are connected from home, please stay engaged and share your views and questions in our chat. Barbara, the first data tells that things went better than expected, and this thanks also to the European Union policy interventions. What implication does the COVID-19 crisis has on convergence, and how important was the European Union policy intervention?
Yeah, good morning, first of all, and thanks a lot to Eurofound for the invitation to this very important event, despite a difficult global context, let's put it that way, or European context. I think we very much concur with the report, the interesting report Eurofound wrote, and also your presentation. First of all, when it comes to the fact that, let's say, accession is a convergence machine when you look at the Central and Eastern European countries, and then also when it comes now to the crisis. I would like to indeed first make a point about the overall impact. You have shown that very impressively. We had a very sharp decline, and what was amazing that in terms of employment drop, we only had 3 percentage points drop. Also, according to our simulations during 2020, we did not have an increase in inequality nor in poverty rates. But then coming to convergence, I think it's important to see that even during 2020, the Central Eastern European countries continued to converge. So overall, we see a slight blip. And according to our autumn forecast, we basically see that convergence resumes from 21 onwards. Now, you asked about the policy response, and I can say yes, in our view, this has played a very important role together with stabilizers and together with the role of social partners. So first of all, the flexibilization of state aid rules and the SGP, the Stability and Growth Pact. Secondly, the flexibilization of cohesion funds that could be used where needed during the crisis. And thirdly, also the new SURE instrument to help member states finance short-time work schemes and thus retain people in their jobs rather than shed workers. So the last thing I wanted to say, all this looks very good, and I think it was a strong policy response, but of course we also know that some people, some population groups were particularly affected: young people, single mothers, people with migrant background and low skills. So this is still an encouragement for us to continue working towards including these people in the labor market and society.
Thanks a lot. Thanks a lot, Barbara. Debora, I read your investment report actually, and I saw that differently than in 2008, investments already came back to the pre-crisis levels, and that the crisis triggered a transformation in economies and businesses. However, the pandemic also left scars with some companies, workers, and citizens that are more at risk of being left behind, actually. Is this the case?
Yeah, thank you very much. So first of all, thank you very much for inviting me to this panel, and then also to have an opportunity for discussing those topics that are so important. Actually, you just mentioned our investment report. We came up with an investment report one and a month years ago, and as you say, we actually had quite a positive stance, thinking at investment being back to pre-COVID level in just 2 years. And that's, for us, it was very important and very much related to the policy support. But also we were opening to a number of warnings due to asymmetries and risk of divergence that we were seeing. So the message was very much so far so good, but watch out at risk of asymmetries in the recovery and the risk of divergence in the recovery going forward. And now, in this moment in time, we see what's happening with the Ukrainian war, the much more prolonged than previously expected energy shock that we see, and the potential geopolitical consequences of the war that will particularly affect some areas of Europe. And I have to say that I am much more concerned on those vulnerability or asymmetries that just 1.5 months ago I was addressing like a risk, but I think they are really concrete risks. And I just wanted to mention a few. The first one is the pandemic crisis was taking really a toll on the less educated people and on young people. We estimated that school closures could have reduction in student lifetime income of 3.5% on average. So that's actually quite a huge number. We had an impact in terms of training, which we were very concerned of, and I will discuss more about it later. But also we saw that there was divergence across the firms. You had a number of firms nicely, and thanks to the policy support, innovating more, transforming, digitalizing more. But you also had at the bottom firms that didn't do anything, they were not reacting. So the divergence also across firms was growing. And in terms of territories, it's true that the Central Eastern European overall have been doing well. But if you look at less developed regions, actually already are coming out from the pandemic, you saw that some of the structural elements that characterize those regions made them less capable to react and to take forward. So we start pre-pandemic with all those asymmetries and vulnerabilities. And now the new shock is coming. And the new shock is naturally closer, geographically closer to some of the low-income regions. We'll have another element that is will bring, and we already started emergency migration challenge all over Europe, and through the energy channel is likely to have a stronger energy shock that will affect particularly low-income people. So at the end, I think that the concern that we saw are all there, and those require policy action to continue actually in the good path that was developed for the pandemic. And there I think on the one side, it's a rule of fiscal policy, very much to address with precise intervention the new shock, the old vulnerability and the new shock that are emerging, but also on I think the concern of divergence across territories, across countries, states, and that also has to be taken into consideration.
Thanks a lot, Debora. Zsolt, how Europe perform in comparison to other geographical areas at the United States or China? I mean, we know that before the COVID-19, forecasts actually were indicating Europe to underperform in comparison to these areas, actually. But is this still the case during and after the pandemic, actually? And do you think that the RRF and the Next Generation EU actually made a difference in this?
Thank you, Massimiliano. I would like to make two comparisons. One is between the previous crisis, the global financial crisis plus Euro crisis, and the COVID-19 crisis. And the other one is a global comparison on how Europe performed relative to its major trading partners. Now, if you look at the two shocks, the shock a decade ago, then at that time, the recovery of employment was very, very slow. For example, in the European Union, employment level reached its pre-crisis level only by the end of 2016. So basically, you know, the Lehman Brothers collapsed in 2008, and employment returned to that level, I mean, almost 8 years later. So there was a very slow recovery in employment. If you look at the COVID crisis, as also already Barbara mentioned, the employment impact was much more muted. It was much lower, smaller, and also the recovery is promising. But if you look at, you know, in a global perspective, then we do see, you know, I would say both positive and negative results for the EU. Now on GDP, again, the United States is recovering faster. I think it's mainly due to two factors. First is the underlying structure of the US economy, which is much more flexible, much more capable of reallocating resources from struggling sectors to growing sectors. And the other one is that the fiscal stimulus was much stronger in the United States than in Europe. I mean, both previous President Trump and current President Biden implemented major spending programs, which were very, very significant. So I think these two factors explain why the US economy is recovering faster. But if you look at employment, then again, we see a stark difference at the advantage of Europe. In the United States, there was a massive decline in employment, essentially because their labor market support, I mean, mostly consisted of extending unemployment benefits, which were I mean, not very widespread and not really generous. In contrast, in Europe, we already had relatively generous unemployment benefit schemes, so there was no need to extend that. And the other support the US provided is lump sum payments to households, everyone, beyond a certain income level, irrespective whether they were hit or not. Now, in contrast, in Europe, I mean, as again, Barbara and also Debora mentioned, there was this very targeted employment protection scheme, so it helped keep people employed. So why the US recovery is doing better on GDP front, the European economy is doing much better on employment front. But not just Europe. I mean, if you look at the United Kingdom or Japan, also in these countries, there were employment protection schemes. But within employment support, there's a very interesting or a very alarming development. And I would just basically mimic what Debora has said, is that people with high education levels and working as professionals, which are typically higher earner people, they actually didn't even suffer job losses, and even in the past 2 years, job for these people increased by about 5%. So despite the pandemic crisis, employment for professionals went up very significantly. But if you look at low educated, low income earners, they did face job losses. In the EU, the job losses is about 8%. So there's a big gap widening between, I would say, the high educated, better paid, and the low educated, least paid workers. It's not only a European phenomenon, it happens almost everywhere, including the United States and elsewhere. I mean, I also look at all countries for which the International Labour Organization has data, about 60 countries, and in almost every country we see the same phenomenon. So in fact, I was a bit surprised to see from Barbara in her initial remarks saying that inequality and poverty did not go up in Europe, because at least in the labor market, we do see a major differentiation between the better educated and higher earners than the poorly educated and lower earners, which certainly a cause of concern for policy going forward. And then, of course, we can also discuss the implications of the war, what implications that might have on social development. But let's leave that for a later discussion.
Thanks a lot, Zsolt. We will have time to deepen this aspect actually during the session. Natacha, how do you see the impact of COVID-19 on economic and social convergence? I mean, as mentioned also by Zsolt, the comparison with the 2008 crisis emerged naturally, and we see a very different pictures, especially in employment or social-related indicators.
Thank you, and thank you very much for this invitation to the forum. This is a pleasure to be here with the colleagues, which I like a lot as well. I would have three points on this. The first point will repeat to some extent what Zsolt just said about the major distinctive dimension of labor markets and the way labor markets have been tackled in Europe in comparison with other areas in the world, and in particular the US. I just finished a short report for the European Parliament that will be published in 2 weeks. And in this report, we do counterfactuals of employment levels, unemployment rates in the absence of policies, them being fiscal policies or sectoral policies at the national level in the EU and at the EU level. And the combination of those two levels, and you mentioned, Barbara, the sure emission is one dimension of it. The fact that we have combined those policies means that we have been much better at protecting employment. And this was compiled with policies that often, not in all countries, but often for wages, well, wage support policies, where wages, a big part of the wages have been nationalized. So on that front, I think it is the crisis has been a shock that allowed Europe to express in a positive sense its ability to have a social and the cohesion policy by associating an EU-level policy and EU-level coordination. I'll come back to that, but also the leeway that national countries were able to exploit. Of course, the policies, the national policies, and in particular the budgetary implications of those national policies were enabled because we have put aside a number of fiscal rules. But again, we can discuss that in the Q&A. So that's the first point. The second point is that we have, like other areas, the US, the UK, been able to have a very strong and very powerful policy mix. In fact, we had the policy mix, monetary policy, fiscal policy, that was probably the best balanced of the main currency areas. Best balanced because we did a lot on the fiscal front, but we didn't do too much. Debora was saying in the investment report, the path was a bit more optimistic than it would probably be now with the Ukraine crisis. But we've been able to create a recovery that up to the global energy price shock that we are having right now was not that inflationary. So the calibration of those fiscal policies, national and EU-wide, and monetary policy meant that we had a good balance in the recovery and the sustainability of the recovery that was not to be seen in the UK, in the US, and where policy adjustment, in particular on the monetary policy side, was already necessary. So that's also a very, I would say, a very positive point. Obviously, the European volet from the recovery plan was a way to neutralize and therefore to allocate the funds in the best in the best way. So I will be very positive on this. The two last points of my remarks have to do with the nature of the shocks that we are facing right now, and the second point has to do with the role the EU can play globally in developing policies and unfolding funds to the global economy. On the first one, we've had, and the previous speakers have said it already very well, we've had a shock that was global, that affected some sectors a lot more than others. We have had a structural reallocation of trade away from goods into services, a restructuring of global value chains, and we don't know what the new steady state will be. But now we also, on top of that, we face this oil price shock and the geopolitical uncertainty that will not make it easy for us. And I'm not sure here that Europe is better equipped than anyone else to deal with those sort of tensions that we have. On my last point on the global economy, and I think it's important to mention it because those discussions are taking a lot of space. The EU is very open towards the rest of the world. I mean, the EIB is financing a lot of countries in Africa and elsewhere with very good results. But I think we have fallen short of being fully responsible and fully solidarity. Particularly, I have one thing in mind. We've seen, you probably remember, in the summer last year, the IMF decided on a new allocation of SDRs. And this new allocation has been massive. It was 500 or 600 billion. And we now have, I mean, a lot of European countries have SDRs sitting in the balance sheet of their central banks. And those could and should be deployed in places where they are most needed. And those places where they are most needed are in some European countries, but very few, but also elsewhere in the world. And I think, I know there was a summit, the EU-Africa summit a couple of days ago or a week ago or something, well, a bit longer, 2 weeks ago, where this was discussed. And I was hopeful that countries would be given the opportunity and the flexibility to use those funds in the countries most in need, to use them directly, to use them through multilateral development banks or other channels. And my understanding is that it didn't come through. So we have to solve this issue because Europe also has a responsibility towards emerging countries. And I will stop here. I know it was a bit beyond the question you asked, but I thought it was worth making the point.
Yes, thanks a lot, really, to also highlight this aspect. So now, for the short-term impact of the COVID-19, we understand actually that it probably went better than we expected in April 2020. But then what will happen now in the future? I mean, we have big challenges as the transition to the green economy, as well as all the implications that emerge from the war that we have now at our borders. So let's discuss a bit about the future, and I remind my speakers to be concise because we have little time, and we would like to give also the floor to the audience at home, actually. Barbara, so talking about the future, we know the importance that the European Commission give to set an ambition for convergence and resilience in the future as well. What challenges are we facing, in your opinion, regarding the post-COVID future for convergence and resilience?
Yeah, thank you. I would say that, of course, we have now heard some challenges about vulnerabilities that come from COVID partly, in terms of vulnerable population groups. We have heard the new challenges, but linked to the war in Ukraine. I'd like to focus a bit on something that is a present but also a future challenge, I mean medium-term challenge in terms of digital and green transition. Because I think, I mean, it's clear that we are highly committed to that. It's clear that we have launched the process with a lot of ambition, and it's also clear that there are many opportunities but also some challenges. And I think that those member states that have the human, the capital, they have the physical capital, they have the institutions, have a lot of opportunities to go fast in these transitions. So I think it is key in this process that we leave no one behind, and I mean member state and people. And from that point of view, that's why I think it's good to concentrate on it now in my intervention. But I think we have some very important frameworks in place, and I just want to briefly talk about it. First, the Pillar of Social Rights and its new action plan of last year. And there are two elements I wanted to mention. First of all, the target setting. We have set next to the green and next to the digital also employment, skills and poverty reduction targets. And what we are doing right now, we're discussing with member states their national targets, and we encourage those that are further behind to set more ambitious targets so that they catch up. I think that's already a very important element, and they're buying into it mostly, I would say. Secondly, we have a number of actions in this action plan, such as the skills agenda, including skills intelligence or improving incentives of individuals for lifelong learning, or the EASE recommendation to support job-to-job transitions, or the draft directives on minimum wages and platform economy working conditions, or yet one more, the recommendation on the minimum income that is coming this year. So you see, all these actions are supposed to also promote social convergence and upward social convergence, and they should help member states to move together as opposed to some losing ground. And the final thing, of course, is our instruments. The Recovery and Resilience Facility was already mentioned, which definitely provides more funding to those that are behind and in particular also encourages institutional reform. There's the cohesion funds that also are supporting convergence. There are several funds that are supporting a fair green transition, such as the Just Transition Fund and the proposed Social Climate Fund. So altogether, I think we have some mix that should push forward convergence. And then let me just say last point, the Commission already came forward in October with a communication on how to react to then already relatively high energy prices, and part of it was also to encourage member states to support vulnerable households, support micro firms that are affected. So I think that is also something that would be continuously an advice, and more reflections might come.
Thanks a lot. Debora, we heard about skills and the importance of skills, actually. And we know also that the recovery and resilience facility is focused on digital and green transformation. Of course, for doing these transformations in an optimal way, actually, skills are important. Do you think that our citizens and our workforce is ready, or we lack skills in this area, and how this can be addressed?
So I think actually on the skill side, that's one of the critical areas at the European level at this point in time. We know the challenge of the digital and green transition, and the fact that new skills are needed, also to take the opportunity that this transformation will bring. So we will have, in both cases, we will have jobs being lost, and creating the new skills needed will give the opportunity actually to also shape the transition in a way in which you keep the works, you keep the advantage in terms of opportunities for people. But then what do we see in terms of skills? So we run every year a survey of European firms, and since we started 6 years ago, we ask what are the key impediments for firms' investment. And since 6 years, one of the top impediments in the last 3-4 years was always the top impediment is availability of skills. All over Europe, 80% of firms are telling us they don't find the skills, and that's constraining their investment activities. We also see on the public sector, when we look at the digital and green transition, and we see public sector capacity to deploy public investment, to design and deploy public investment. At the local level, municipalities as well tell us that availability of skills, their own technical capacity, is a constraint to investment activities. And we saw it also with the Recovery and Resilience Facility. I think the Recovery and Resilience Facility is rightly associating also resources for building the skill at the public sector level, because implementation of the program is extremely important, and failure to implement the program will be a real issue for many of the countries and territories. But this requires this skill on implementation capacity at the national level and at the policy and at the local level. And that's a good part of the program, is to really look into this aspect. And then we have, if we think more at the firm level, I was mentioning the 80% of firms that tell us that they don't have the right skills to, and this is a barrier to investment. During the pandemic, I saw something that raises concern. So actually, training was reduced, particularly training done by the firms that were keeping people attached to the jobs, also thanks to the policy support. They were at the same time reducing training activities. And what is worse is that the small and medium enterprises did it much more. Also, the firms that were non-transforming, they were training much less. So in reality, what you see is that the divergence that I was mentioning before was a kind of coming in. So if you are firms in difficulties, you help even less your workers to build the new skills that you know will be needed for the future. So the concern is really how to invert this trend and what to do. And I think one element to consider for the future is that policy support that comes incentivizing the relationship, the firm-employee relations should be more also having as a precondition some more retraining of people. So kind of forcing the training, particularly to build the skills that are completely missing in the European labor market. And I think very much looking at those that are needed in the green transition and again in the digital transition.
Thanks a lot, Debora. Zsolt, we know that we are in front of important challenges. From one side, there is the digital and green transitions. On the other side, there are all the geopolitical implications of the Russian war in Ukraine, actually, with inevitable implications on energy prices, as mentioned earlier, actually. How do you think that this challenge will impact on convergence in the European Union, actually? And do you think that we have all the necessary tools to face them, and that they will be enough for this challenge?
Thank you for the question. I would like to respond by briefly elaborating 3 points. The first is the impact of inflation within the society. The second one is convergence across European Union countries. And the third one, possible European Union-wide instruments. So the first one on inflation, I mean, even before the war broke out, I mean, due to also the tensions, energy prices already started to skyrocket. And since energy impacts many other things, also food prices started to grow. Now, if you look at the consumption pattern of households in the European Union, and let's say divide European population into 5 groups by income, then what we see is that in the poorest 20% people, they spend about 2/3 of their income on housing-related issues and food combined. Certainly housing-related issues also involves energy prices. By the richest 20% only spends about 1/3 of their income. Now, since certainly energy prices increase the most, but also food prices are going up, even before the war broke out, it already had an adverse impact on inequalities across Europe, simply because the poorer people spend a much larger share of their income on energy and food. Also, typically poorer people, they don't really have sophisticated investment, but they, most of them just keep a bank account where they essentially earn 0 interest, while inflation is now, much higher in many countries, meaning that there are much fewer savings, much lower savings are declining in real value. So I'm afraid inflation already has a very adverse impact on the poorest segments of the society. And the second point on within country or across countries, convergence and prospects. Even, if you look at let's say the past 20, 30 years, the biggest challenge in Europe was, I think, a relative fallback of Southern European countries. If you look at, for example, Italy had the same GDP per capita in the late 1990s as Germany, and now GDP per capita is 1/4 less. So there was a major relative decline, a divergence of Italy and also some other Southern European countries. And we look at the impact of the war. then it will be again asymmetric. I mean, countries closer to Russia and depending more on Russian gas will suffer more. I mean, and basically most the Eastern European countries, but also Italy, almost entirely depend on gas from Russia. Now, for me, it's inconceivable that we continue gas imports from Russia for long. I mean, they are imposing various sanctions on Russia, but at the same time paying almost 1 billion euro every day for gas imports, and thereby, providing a lot of liquidity for Russia to finance the war. I mean, I'm not a political strategist nor a military expert, but I think it simply cannot go on that we continue import gas from Russia and pay, a huge amount every day. So this gas import from Russia will have to stop sooner or later. But again, if that happens, it will have a major asymmetric impact across countries, with Eastern and Southern countries more impacted by its impact. And this can give rise to or amplify existing vulnerability. I mean, again, we know that the public debt in Italy is much higher than, let's say, in the Netherlands. So the Italian government might find it more difficult to withstand the really adverse impact of skyrocketing energy costs. And this leads me to my third point on European instruments. Now, certainly the Recovery and Resilience Facility is a very useful tool, but it has, a very specific role. All countries promise to meet certain milestones and targets to get that money. So they cannot just simply reallocate that money to other purposes, because for that, there would be a need for changing the regulation and also changing the national plans and the national milestones and targets. So something else will be needed, and I'm convinced that we would need a new fund. I mean, I don't want to give a name to that fund, but basically a fund that will help those countries which were especially hard hit by the economic impacts of the war. I'm really afraid that without such a fund, we might see that countries with weaker public finances will really struggle to withstand the economic impacts of the war. And the last thing we need is a new financial crisis in Europe. So I very much advocate a new fund to jointly shelter the burden of the war. Thank you.
Thanks a lot, Zsolt. And yes, we don't need a new financial crisis in Europe, this for sure. And this brings me actually to Natacha. We are facing these challenges with a high inflation already and high debt actually, and with some countries that has a higher debt than others, and so a more reduced fiscal maneuver actually. How we can live with this challenge, the challenge of the high debt, especially considering that at the moment we have a more fiscal flexibility, and what will happen actually in the future for this flexibility given this new challenge?
Well, that's a question that is has two sides really, because debt is a stock and it is with us. We discuss it in different ways depending on the conjunctural developments, depending on the shocks that hit us. So obviously, a couple of weeks ago, we were in a mindset of normalization, of setups, of new discussions around European fiscal rules, and that was one of the points of priority of the French presidency of the European Union. But now, obviously, with the developments in Ukraine, the tone and the mindset is changing for good reasons. We have a situation of war and probably of renewed slowdown. So that doesn't make the current situation a very easy one, because before the war, we already had a constellation in which monetary policy in Europe or in EMU was lagging that of other large central banks for good reasons, but still normalization was being set in train because inflation was proving to be less temporary than what people had thought. Now, the difficult point now is that so far we have handled inflation and the impact of inflation on purchasing power of citizens through fiscal policy. In various countries, we've had some fiscal expenditure to tame the impact of oil prices on consumption baskets and so on. But we also know that this is not a policy that will be sustainable for long. And in the normal train of things, this should be handled by monetary policy. Now, monetary policy now is in a very bad place because it should be normalizing according to its central mandate of price stability. But it will be very difficult to do so because a number of risks have re-emerged on its macroeconomic assessment, macroeconomic scenario. The recovery will probably be weaker than expected, and on geopolitical risks. So I think this doesn't make things very, very easy. There's no simple answer, and we'll have to. It will be a very fine line in the coming weeks between keeping the promise that price stability will prevail, while making sure that the recovery is not impinged.
Yes, exactly. Very good. Thanks a lot. I have some questions from the audience that I will pose to all of you, actually. And we heard that there is COVID inequalities and there is COVID polarization. So our audience is asking, do you think that there is a risk of increasing of polarization in employment and working conditions? And how can we counteract this trend?
I can say something if you want.
Want to? Yeah, Barbara.
Yeah, okay. No, I think it's a very interesting question, and I would say despite all the opportunities we see from digitization, for instance, I think it's a well-known challenge that there could be also an increasing polarization. And what we see, for instance, in the context of platform work, that some people are categorized as self-employed when in fact they are more in a dependent situation, which means being considered self-employed, they don't have protection through EU labor law, they don't have social security. And I think the recent, and that's answering also the question of response, the proposal by the Commission on working conditions in the platform economy seeks to reverse this kind of employment status so that these people, roughly 5.5 million, would get protection. Another thing that I could say also is that, of course, while the green transition is very positive, you might also get some people who are exposed to asbestos and therefore see a worsening of the employment situation. And also here there is some response in terms of increasing the limit values and so on. And maybe the last thing I wanted to say also is that, of course, what we have been all saying is how important skills are. And by increasing skills at the lower and middle end, you can also make a huge difference in terms of people getting better jobs. So that is another element that I would definitely say we need to continue.
Thank you. So we have another questions actually from the audience actually, and there has been a COVID-19 crisis, and now there is the Ukraine crisis actually. What do you need to focus to avoid the divergence and get back to upward convergence? It's a big question, actually. Want to try to address? Debora, you are first.
I don't think that I will give the full answer, but I can share what I have on the top of my mind in this moment as the two priorities that we have to look at the European level. One of the concerns that we have is, again, you think about the corporate sector and how the corporate sector faced the COVID crisis, and the policy support was really instrumental to keep firms afloat and manage the transformation of firms. And now we are in a moment in which most of the policy support is right. So the plan was to phase out from this direct policy support to firms and to let the firms just face on a standalone the recovery. The problem that I see is that the new risks coming in are risks that affect the cost of firms. The energy crisis, the protracted energy crisis will impact firm revenues, firms' profitability, and the resilience to the withdrawal of the policy support is not so clear now. So on my side, one of the immediate points to consider is whether to prolong some of the direct support of firms, at least on a guaranteed credit point of view, issues that may help firms face in case of more liquidity tension coming up. And the second point is, again, on skills. I think the issues of skills is that the propensity of people in the most endangered job to by themselves look for a retraining is limited. So I think there should be something more on the policy point of view, incentivizing these people to get retrained and to look at the skills. And that's, I see it more as a public sector service rather than something that individuals can do by themselves.
Thanks a lot, Debora. We would have a lot of other questions, actually, like the impact of the economic shock on energy inflation and so on. But unfortunately, the time is running out. Time is a tyrant, as the Latin said, actually, and we have to move on to the last bit of the session. And here, actually, I would ask you if you could share with us in one sentence or so, actually, your takeaway point, a message that you want to share with our audience as a result of this session. Natacha.
One is that the crisis has resulted in a reallocation of wealth that was massive. And we concentrate a lot on flows, but we should not forget about stocks. And this will have implications, long-standing implications. So I think that's one thing to keep in mind, and we tend to forget when we deal with crisis measures. And the second one really is enablement. And I liked the focus of Debora on skills, because at the end of the day, what we studied in the past as human capital or intangible capital, we have, in the end, skills and the ability to develop skills, to change skills, to update skills. All
we cannot hear you anymore.
And for economies.
Thanks a lot, Natacha. Zsolt, in one sentence.
Extraordinary support in many dimensions will continue to be needed. I very much agree with all the skills and digital and social aspects. But this will have a very obvious implication that fiscal rules cannot be reinstated from next year, because simply countries can't start fiscal consolidation at a time of a war. So I think at least the restart of the fiscal rules should be postponed by 1 year. And I'm also very much convinced that we'll need to design very quickly a central European Union-wide instrument to address the challenges of the war.
Thank you, Zsolt. Debora. We cannot hear you. We cannot hear you, unfortunately. So
Sorry,
Barbara.
sorry, I was muted. I point as well to skills, the priority of investment in skills, human capital. And I also share the concern on the risk of divergence and asymmetries. And I think the war will have consequences at the European level. And I also think that we should think of the instruments to face the consequence of the crisis.
Thanks a lot, Debora. Barbara, in one sentence.
First, I should say that for me, this is not the moment to comment on fiscal policy, fiscal rules and instruments, I think, while the reflection is going on. So let me just say that it's clear to me, both looking back at the past and ahead, that in any case, we need a very strong employment, skills and social dimension in whatever we do. I think that we have learned, and I think that's definitely something we also need to keep for the future.
Thanks a lot, Barbara. Thanks a lot to all our speakers. Thanks a lot for your participation. And the next session will be up shortly, and my esteemed colleague Barbara Getzenberger will discuss the future of work. We are now coming back all working in office as the COVID-19 is phasing out. And so what is the future of work? Are there dark clouds or silver linings? Thanks a lot to everyone, and stay tuned for our next session.